You're probably watching this because DocuSign stock is crashing and you're wondering why. Now, the word crashing is pretty strong, but fair. So today the stock was down 24%. Since the beginning of this year, it's down 55% compared to a NASDAQ return of about half of that. And then over the past rolling year, it's down over 70% compared to a NASDAQ return of negative 11%. So crashing is about right based on where the share price sits today. So why is that? Now, we're not going to talk about the opportunity. That should be something that you're already familiar with. There's a $50 billion total addressable market, according to the company, around documents. That's preparing documents, signing them, managing them, etc. They have 1.24 million customers. Now, we had thought these were individuals that used their solution, but this actually happens to be paying customers. That's a pretty large number. And they have a 70% leadership in e-signatures. That number's debatable in terms of where it sits, but it's largely accepted that they have a dominant share of the e-signature market, and then Adobe is in second place. So today, they say the market processed their earnings, which were announced yesterday, and the short-term look there would be that earnings per share of 38 cents missed Wall Street's projection of 46 cents per share. So that wasn't good. And then when it came to revenue, they actually outperformed. So some of that reaction was based on their underperformance in the quarter, but we're not necessarily concerned with a firm that has 78% gross margins overspending a bit. So this is a table of the pure SaaS companies that are in our tech stock catalog. We have 430 stocks now in our catalog. And one of the columns, it's an Excel worksheet, one of the columns is pure SaaS or some SaaS. And these are the pure SaaS companies and their gross margin. So DocuSign is right up there at the top with a strong gross margin of 78%. So we were less concerned about the earnings miss and more concerned with this slide. So we took here the fiscal year 2023, so that's this year. The whole fiscal thing gets really confusing, but we took the guidance that they gave prior to yesterday and compared it to what was adjusted yesterday. And you can see that billings here have fallen about 7%. So billings, while we always talk about only focusing on revenue, billings in the case of DocuSign are useful because DocuSign bills their customers ahead of time for usage, and then they recognize that revenue over the year. So billings become kind of a leading indicator of what revenues will look like, and they adjusted those downwards. So the implication is that revenues will also eventually be adjusted downwards. Now, they didn't do that, and our take on that would be that management teams typically like to get all the bad news out of the way at one time. So if they didn't think they were going to hit their revenue guidance, they should have adjusted it around the same time that they adjusted bookings. But that's not how the market saw it. So one analyst here at the bottom, we put a couple comments from analysts, said that this suggests perhaps further downside to already reset fiscal 2023 revenue estimates. And this other comment says that this is the third consecutive quarter that DocuSign guided next quarter billings below consensus. So when we talk about the leading indicator, this is a good slide to show that. So on the left, you have billings per quarter, and the percentage there, that reflects the year over year gain. So in Q1 fiscal year 2022, there was a 55% increase in billings over the year prior quarter. And then see how that declines over time. That's not a good sign because that means that customers are spending less. And we'll talk about why that might be the case. And then when you look at revenue on the right-hand side, see how it lags. So it's just now starting to realize the decline in growth that follows the decline in billings growth. So billings is useful as a leading indicator. And the question is, well, why would growth be slowing? Well, one of the things that we can look at is this metric called net dollar retention. So this is a SaaS metric that looks at how much extra money your existing customers are spending. So if your existing customers are at a net dollar retention rate of 100%, that means that they're spending the same every year. If it's less than 100%, that means they spent less this year or whatever time period you're looking at than they did the previous time period. That's not good. So a good SaaS firm will have around 120% or upwards in terms of what net dollar retention looks like. If you look at this, we cobbled together a couple slides and produced this little historical chart here. You can see that in Q1 fiscal year 2020, they had net dollar retention of about 112%. That was right before coronavirus hit. And then you can see how it increased over time. And then you can see on the far right, the most recent number from this last quarterly earnings call is 114%. So it's settling back down. And analysts have been talking about how, well, the growth for DocuSign was spurred on by the pandemic. Well, no doubt it was. People were working from home and needed to sign things, and that you would see customers of DocuSign increasing their spend during the pandemic. That just makes sense. The fact that spend is decreasing more down to normal levels, that makes sense as well. So net dollar retention rate, anything around, let's say, 112 to 119%, that's what management talked about in the earnings call, is what we should be expecting, and that these previous numbers were more indicative of the exaggerated growth due to the pandemic. So that seems to make sense. Now, another metric that we can watch would be this very important metric, which shows the number of customers they have with annual contract value greater than $300,000. And you can see that that's been growing meaningfully over time. So DocuSign, when they first started out, focused on very small customers, and then they pivoted their focus towards enterprise, and this metric helps show that. So you can see that for Q1 fiscal year 2023, that's the quarter that was announced yesterday, or the concluded yesterday, that the metric here, 886, is over 852. So that increased that quarter. And this is a bit difficult because the numbers in blue there, the darker blue, are annual, and the lighter blue is this last quarter. But they have a strong growth. So we want to see this growth continue. We want to see large customers spending more. So that's a whole lot easier to get a large customer to spend more than it is to get a lot of small customers to spend more. Now, when we look at DocuSign, and this is kind of a important framework that we use in analyzing this company, it's that they have over 1 billion users and 1.24 million paying customers. The fact that they have that many customers that have already opened their wallets makes it very easy to sell them additional solutions. So you can see here, this is a common marketing metric. The probability of selling to an existing customer is 60 to 70%, while the probability of selling to a new prospect is 5 to 20%. And there are all kinds of numbers out there that talk about how much easier it is to sell to existing customers, which is why retention is such an important metric. So we actually don't have gross retention, which is the number of cancels for DocuSign. That would be an interesting metric to have, but most SaaS companies don't provide that. Now, what we've shown here in the upper right are the 3 different solutions that DocuSign sells. So they have electronic signatures. Well, we're familiar with that. That's their flagship product. Then we have contract lifecycle management. That's a new solution that they've put together after acquiring a number of firms. And then we have electronic notarization. So what we're lacking here is a breakdown of these revenue segments so that we can see where the growth is coming from, how much growth is being contributed in terms of revenue growth from these acquisitions. Well, when it comes to eSignatures, the competitor there is Adobe, and Adobe Document Cloud is a $2.1 billion business versus, or sorry, that's reverse, right? DocuSign is a $2.2 billion business versus Adobe Document Cloud, which is $1.97 billion. But we can't see what percentage of the revenues from both those businesses come from eSignatures. And we know that that's the flagship product for DocuSign, so we assume a majority, but we need that breakdown really to be able to tell how effective their acquisitions have been. So when we look at contract management, so we can pull up Gartner's little quadrant here and take a look at who the leaders are when it comes to contract management. You see DocuSign right there, they're a leader. And then also Icertis is a private company, a startup we've covered before, and they're considered to be a leader as well. So we took a peek into the Gartner report to see what they had to say about these solutions. And about DocuSign, Gartner says that their product addresses all contract types, but has a higher concentration of customers using it for sell-side contracting. Well, sell-side contracting, that's actually time to close is very important for sell-side contracting. So the adoption there, the value proposition is probably that customers can do things faster. And then since the acquisition that Gartner made, DocuSign made in, I believe it was 2018, we'll look at that in a second. Since that acquisition, its CLM customer count has almost doubled to over 1,200 organizations. Well, that's great. That's a very small percentage of 1.2 million customers that they have, but that's great to see such strong growth. And that in 2020, they improved the analytics capability of their CLM solution by acquiring Seal Software. They're one of the first CLM platforms to get FedRAMP authorization in 2017 so they can sell to the government. And last year, they started servicing the Department of Defense. And the top 3 industries for DocuSign's CLM solution are high-tech, healthcare, and financial services. We look at Icertis, they have 225 customers or over that number. The top 3 industries are, again, some overlap here. So we have high-tech, healthcare / pharmaceuticals, and retail. They're a Microsoft partner. Their software is typically deployed on Azure infrastructure, and it's heavily integrated with MS Office. However, clients have reported some difficulties with implementation and upgrades, and it said this is to be expected considering the company's growth, over 75 go lives in 2020. So they're growing quite fast. This Gartner report was from last year, so it's a bit dated, but it still gives us some insight into the relative size of these 2 CLM offerings, one being private, so we don't know much about it. Then there's the notarization tool that DocuSign acquired. And it's interesting that Adobe also has partnered with a firm called Notarize. They've taken in about $213 million in funding. They're now working with Adobe to offer, let's say, remote notarization. I've actually used that functionality for a government-related issue, and it works very well. You can see here they have 1,000 on-demand notaries that are located all over the world, so you can very quickly access a notary when you need one, and they have a lot of customers using that. So we'd love to see some insight into how the notarization functionality that DocuSign acquired, how that's working out for them. So here you can see the acquisitions that have led to the 3 product segments that DocuSign has. Starting in 2018, they acquired that CLM system, and then they boosted its capabilities in 2020 with the acquisition of Seal. Same year, they acquired Liveoak, which gave them the notarization capabilities. And then last year, they acquired this firm, Clause.io, which gives them some smart contract capability. So without having these products segmented, when we're looking at revenues from DocuSign, it's very difficult to see what sort of success they're having. And I looked through the last earnings call, the transcript, and I didn't see any of the analysts on there who were asking a lot of different questions that seemed to be more focused on that bookings guidance change. Nobody really probed what these breakdowns look like. So that's something that we seem to be missing. Now, when we look at DocuSign today, forgetting about the decline in share price, if it's a great company, you want the share price to decline so you can add shares cheaper. A key advantage we see is the 1.24 million open wallets, yeah, that's right, 1.24 million open wallets that DocuSign can now sell additional products to. And maybe it's taking some time for them to let's say, integrate those acquisitions they made and then to sell those product solutions. It's hard to say, but one would hope that now that they have all these potential customers, that they're able to consistently over time start selling them more solutions and also increase usage on existing solutions. So we'd love to see more color on segment revenues and the growth of each of those segments. But in lieu of that, we'll be watching key metrics, which are that net retention rate doesn't decline below 112%, which is what is historically the lowest it's been, and that the annual contract value for customers that are over 300K, that number of customers continues to grow over time, which is an indication of how well enterprise usage is expanding. So please put your comments in the comments section. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.